Welcome to Section 3 of PNJ Group's ASC 710 training. You have already determined whether to accrue. Now you need to know how much to accrue. This section covers the measurement of the compensated absence liability, the special rules for sabbatical leave, and the recognition triggers for voluntary and involuntary termination benefits. By the end of this section, you will be able to measure the compensated absence liability at the right amount, using the right pay rate, including the right cost elements, and adjusting for expected forfeitures. You will apply different accounting treatments to sabbatical leave depending on whether it is for rest or for productive duties. And you will know exactly when to recognize a termination benefit. Whether the employee chose to leave or was told to leave, those are two very different accounting events. Here is a measurement mistake that gets missed surprisingly often. The vacation liability should be measured at the rate you expect to pay when the employee actually uses the time, not necessarily the rate they earn today. If you know a company-wide pay increase is coming before most employees will take their vacation, measuring the liability at current rates understates the obligation. Whether a known pay increase is significant enough to reflect in the estimate is a judgment call, but it needs to be made consciously, not defaulted to current rates out of habit. The liability is not just the raw salary cost. Employer payroll taxes, including FICA, FUTA, and state unemployment taxes, must be included because the employer will owe those taxes when the absence is actually paid. If health insurance or other benefits continue during the leave period, include those costs too. And then reduce the total for expected forfeitures, the portion of accrued balances that history shows will never be taken or paid out. Use actual historical forfeiture rates rather than estimates pulled from thin air. The calculation is a liability, not a rough approximation. The vacation liability calculation follows a simple but precise logic. Start with the total accrued vacation hours across your entire workforce. Multiply by the weighted average hourly rate at which those hours will be paid. Add the employer payroll tax burden, roughly 8% of wages in many situations, though the exact rate depends on each employee's position relative to the FICA wage base. Then deduct expected forfeitures based on historical patterns. The source document example gives you a concrete walkthrough. 5,000 accrued hours at $35 per hour produces a gross liability of $175,000, plus $14,000 in payroll taxes, less a 10% forfeiture deduction, landing at a net vacation liability of $170,100. Sabbatical leave, extended paid time off granted after a set number of years of service, sounds straightforward, but a SC 710-25 draws a meaningful distinction. The question is, does the sabbatical benefit the employee for past service, or does the employer actually get something back through the sabbatical itself? That question determines whether you accrue the cost over the qualifying period or wait and expense it when the sabbatical happens. This is a surprisingly common area where teams apply the wrong treatment. If the sabbatical is purely for rest and recuperation, the employee takes the time off with no work-related obligations. The cost is accrued over the qualifying period of service. The employee earned it by working those years, so the expense belongs in those years. But if the sabbatical requires continued duties, research, reporting back, publishing, then the employer benefits through the employee's sabbatical activities. That is not a reward for past service. It is a current period cost. Recognize it during the sabbatical, not over the years leading up to it. The rule follows a simple principle. Who benefits from the arrangement determines when you recognize the cost. A special termination benefit is a voluntary early retirement or resignation package. Management offers it for a short window to reduce headcount without forced layoffs. The recognition trigger is acceptance by the employee. The moment an employee says yes and the amount can be reasonably estimated, you record the liability. Not when the offer goes out, not when the board approves the program. Acceptance is the trigger. This distinction matters because in practice, Companies often set up the program weeks before any employee commits. Recording a liability at program launch, rather than acceptance, is premature and incorrect. When management decides to lay off employees, not as a voluntary program but as a business decision, the liability falls under a SC 420, and here is where teams get into trouble. All four conditions must be satisfied before you record anything. Management has approved a detailed plan. The plan identifies the affected employees and their functions and locations. The plan is unlikely to change significantly, and the plan has been communicated to employees with enough detail for them to know what benefits they will receive. Board approval alone is not enough. An internal memo is not enough. Until the plan reaches the employees, the liability stays off the balance sheet. Premature restructuring accruals are one of the most common findings on compensation audits. 3 big measurement ideas to carry forward. First, the vacation liability uses expected future pay rates, not today's rate. Second, include payroll taxes and benefits and reduce for historical forfeitures. Third, termination benefit timing is determined by who triggers the event: the employee accepting a voluntary offer or management communicating a mandatory plan. Getting these triggers wrong is one of the most audited areas under this standard. Next, we move into deferred compensation, a different structure but the same principle: accrue when earned. Thank you for completing this section on measurement, sabbatical leave, and termination benefits. Thank you for watching. Subscribe for more training from PNJ Group.